Yo, what's up, everyone? Hello, welcome back to Mr. Money TV live on Thursday night. Yeah, and tonight we have something interesting. You guys, how many of you guys here are StashAway users? If you are StashAway users, just write one for me in the comment, guys. Just write one for me in the comment, because tonight we have Ken once again to join us, right? And we're gonna talk about StashAway. For those of you who are investing right now, you know that the market has been going through some crazy weeks over the, I wouldn't say weeks, I would say months, right? Yeah. Like we had all the news about inflation, and then we had this commodity all shooting up in price. Then after that, we have all the talks, and then the market went down, correction up and down, everything like roller coaster like that. And then right now, StashAway say they are re-optimizing their portfolio. So I believe that many of you, when you turn on the StashAway app, you actually see this one notification here, right? It says StashAway, we are talking about our portfolio, right? And having said that, having said that, I believe many of you have questions. So you guys can spam him all the questions. Yes, you guys can spam him all the questions later. But right now, let us have Ken to actually join us, and he will be sharing with us what is happening with StashAway lately. All right.
Hello. Hi, Peter, and hi, everyone in the audience. To my Muslim brothers and sisters, belated Selamat Hari Raya Haji. Not very celebratory, obviously, because we're all at home, but hopefully soon enough we'll be able to celebrate. And yes, as Peter said, we are re-optimizing. So Selamat Hari re-optimizing. I think that's something we should see if it catches on, right? Once a year we seem to do
Yeah,
re-optimizing.
that's
So we
right.
do
That's
we
right.
do
Yeah, we
uh,
should we should ask the audience first, right? One thing, how many of you guys here actually are not investing in StashAway? If you're not investing in StashAway, just write two in the comment for us. Just write two in the comment for us, right?
yeah, how many
No.
of you are new? It's a very good place to start because it's very important to understand how any platform manages your money. Especially if
That's
you're, you're
right.
you're you're handing it over to someone. You're not choosing your own stocks or your own funds. How if you invest it with Stashaway, how do we manage your money? What's the philosophy? Right? It's good to
So
know.
you guys just stay on in this show throughout, and later I'll reveal to you what's my return on stash away so far as well. All right. Yeah. So stay on, go and share the video. And tonight, maybe Ken will throw in some goodies for the new people who are joining. But generally, there's already existing goodies, lah, right? Yeah, which is 0% management fee, right? For the first 3 months. All right. So
Yep.
now, Ken, for some of the people here who are watching, just for the benefit that some of them may not know who you are and some of them may not know StashAway, maybe you just want to do a very quick introduction of what is StashAway and who you are.
Sure, sure. So my name is Ken. I'm the country manager of StashAway. I have over 12 years of experience in the financial services industry. I've known Peter here for 3 years, which means that since I started StashAway, I've gotten to know Peter, and then since then, his channel and our business here in Malaysia has grown tremendously together. So that's always nice. I started my career with Khazanah in their investments division. And I moved on to Alvin Huang to become an investment banker. I helped companies go public, list, and then StashAway came knocking, and here I am. So if you don't know what StashAway is, the very simple way to look at it is we're like a digital fund manager. You download the app, you deposit money with us, we invest the money for you, and you must always ask then what is the actual exposure? What am I actually investing into? And we invest globally, so we have different exposure. There's this multi-asset, there's bonds, equities, property, and gold. So you get a very broad, diversified portfolio. And if you're ever thinking of diversify outside Malaysia, StashAway is a very good way to start.
Yes. Now, over the past few months, right, a lot of people have been complaining about the Malaysia market. Number one, I think as the global economy recovers and markets are going up, Malaysia market seems to be lagging behind, right? For those of you who are investing in the stock market, you know that very well. And there are many reasons that contributed building to that factor. And one of it is our very exciting political scene that is not really helping the stock market. But tonight is not for the night to talk about that. But the point is this: as Malaysia goes through this kind of really unstable period, what happened is that Malaysian ringgit actually goes down. And as Malaysian ringgit goes down, one of the things that happened is that a lot of people are asking this question: Peter, should I be investing my money into overseas? I would love to invest my money in Singapore or maybe America or whatnot. Now, the thing is this: in the past, for those of you who actually know, in the past, if you want to invest in the US or you want to invest in Singapore, you need quite a significant sum of money. If you are saying that you only have 200 ringgit a month to set aside, right? Sorry lah, you're not going to be able to invest in the US lah. But the thing is that with StashAway, it gives you this advantage of being able to invest even with the littlest amount, so that it allows you to invest in the US, like even just 100 ringgit a month, right? And what happened is that StashAway would invest in the US ETF and global ETFs for you. And yeah, that way your money is out of Malaysia. And when Malaysia ringgit drops, you get more return. And that is the reason why that lately, if you look at StashAway as well, you see kind of like a little bit of extra return as well. Now, one thing is this: many people are actually asking about this re-optimization thing. So before I go into details, right, Ken, would you like to share with us how does this robo-advisor work, and what is this re-optimization all about?
Yeah, so the term robo-advisor comes from the US, and really it is down to two functions that the robo-advisor performs. The first one is it helps you recommend what portfolio you should use. So you don't really need to be a master stock picker, Benjamin Graham type of person to pick a portfolio. We have 12 of this to choose from, and we can actually recommend one to you. So that's the first function. The second function is that we rely on a system which we created, it's proprietary, that actually is a systematic way for us to invest your money. So basically, we look at where we are in the economic cycle, because you will go through many economic cycles in your life, and you want the best portfolio given where we are in the economic cycle. So we look at where we are in the economic cycle, and we give you the best portfolio for that cycle. So for instance, if it's in a recession like we were in last year, you would have more heavy exposure to bonds and gold, which do well in bad times. And then where in good times, you want more cyclical assets. And then now with the onset of inflation, what assets would do well in this environment? So we change the portfolio for you. So if you think about each portfolio having 7 to 9 ETFs, each ETF is like a Lego block to build the whole portfolio. When the economic environment changes, we change those ETFs for you. And not only do we change it for you, we let you know when we are doing it. So like today, we are in the midst of changing the portfolio. We'll tell you about it, and we'll tell you why as well, right? So you know exactly where your money is, why we're doing it. You understand what is the logic and philosophy behind us managing the money. So it's not like, oh, robo-advisor is some sort of like black box, some sort of tech jargon stuff that you don't really know what's going on. For us, it's actually very transparent, and that's why I'm also very keen to share how we've changed the portfolio.
Yeah, for those of you who are wondering how it works, right, to a certain extent, I'm not going to talk about their framework because I don't think I'm qualified to talk about it. But for those of you who are actually wondering how this robo-advisor concept works, is this. Now, you have to first understand that the end asset here we are talking about are ETFs, which are exchange-traded funds. Now, and when you invest in exchange-traded fund, as usual, if you were to only invest in one, then your risk is not being diversified away lah. So let's say you are only investing in the S&P 500, which is fully based on US equity. And when US equities go down, then your whole portfolio will suffer. So usually, in order to be a wise advisor, the first rule always is this, right? Diversify. Now, however, diversification always comes with money lah, Yeah, so one unit of S&P 500 will be about 200 USD. So how much can you diversify, right? Yeah, and you got to read through everything. Yeah, that's another one part. So the role of StashAway, for those of you who actually don't understand, is that they pick and select a certain amount of ETF. I think about 16, right? Yeah.
We have in our at any one point in time, we choose from a universe
library,
of 30. But yeah, 16 or so will be selected to be spread amongst the 12 portfolios.
Right.
So in each portfolio, there's usually 7 to 9.
Right. Yeah. So basically, they have about 30 ETFs that they're shortlisted, that they think they are good, and then they're gonna pick and base pick the different kind of a ETF based on your risk profile, which at the moment
Yes.
you sign up for the app and then you know answer these questions and stuff like that. And then they are gonna mix and match for you accordingly, according to your risk appetite. Now, how do they know what is suitable? Basically, correct me if I'm wrong, they did back testing with their framework. They already kind of have an index of how much risk this particular ETF is, how much potential of earning this ETF is, and then they mix and match according to your risk appetite based on that. Now, and then that is actually the idea. So basically, that is actually a robo advisor for those of you who do not understand. Now, I think until today, there are still some misconception in the market. Some people say that it's a black box, you know, yada yada yada. Now, I think there was a particular video that talks about StashAway as a black box. Now, I wanna say this one thing, that don't really think of it as a black box, because number one, actually, I think StashAway is quite transparent to tell you their framework of how they make it happen. But I know that for many of you, it's going to be a little bit hard to understand. Yeah, but all you need to do is just go and check out their academy. They have a lot of articles there. Like right now, the re-optimization, they will tell you exactly it's because due to what reason they are re-optimizing. Now, I would personally think that if you're a personal financial advisor approaching someone and telling someone to adjust their portfolio, right? I think that's more black box than StashAway to a certain extent, because at the end of the day, your brain is a black box, right? You know what I'm saying, right? No one really knows what you're thinking. And as a financial advisor, as we pick, okay, no, I'm not a financial advisor, right? But as you pick those combination of ETFs for people, is it based on gut feel? Is it based on real numbers? You know, I think it's easier for StashAway to justify why they put it, because they have a whole infrastructure to actually do the calculation than an individual person. Now, I'm not saying that who's good, who's bad. I'm just saying that at the end of the day, it's not really that much of a black box, right? That's the point I want to tell you, because we know that there's a video that talks about it being a black box, and then it makes it sounds like there's something that we are not telling you, but actually not exactly. It doesn't really work that way.
There's a lot that so I think it's a good point, you know, and if you are skeptical, it's fine, because it's your money, and whatever you invest, you should understand, right? You shouldn't be scared to learn just because someone says it's a black box, right? Actually, if you do spend time on our website and you listen to Peter, and I go on a lot of YouTubers channels, you know, I think we explained it pretty well, right? And the basis is actually very logical. And along the way, when we change the asset allocation, we do communicate it, right? We email you, we write articles about it, we come on shows like this. And actually later, I have a few slides that I can show as well that illustrates not just the logic, but also how it's changed from one portfolio to another. So I can bring that up later, Peter, when you're ready.
That's right. Yeah. Oh, yeah. And another one more thing that I just want to mention, right? I hope this doesn't get you into trouble, Ken. I hope it doesn't, since it's not a paid kind of like live, right? So that's it's not like an advertisement. But the point I want to say is this, right? You see, the when it's an active unit trust fund with a fund manager actively managing it, it is more black box than StashAway. The reason being is because the fund manager have to pick and select individual stocks based on information and knowledge that they can't contain within a fund fact sheet to tell you all the reasons, because there's too many reasons, right? And certain reason they can't tell you because it's also corporate secrets and stuff like that, right? Now, however, for StashAway, it's actually very straightforward, because they only invest in ETF. And ETF is an average of an index, right? At the end of the day. So there's literally nothing much of a secret to talk about. Instead, unit trust funds have more black box than StashAway. That's what I want to say. But I'm not saying that one is better than the other. I have investment in both. I think to be very neutral and very fair, it is StashAway, being the nature of it as a ETF, it has a very general kind of risk. It takes a market average. So the earnings is kind of like within the expectation of average, right? Yeah, but it's an equity good average, bond good average or whatnot, right? But for unit trust, there's a chance that they can way outperform, but there's also a chance that they can way underperform. depending on how good is it, right? But this warrants for another session and another video altogether, I would say. But I just
Yeah.
wanted to put it out there and clarify because I understand that a lot of people don't really get this point.
Basically,
Yeah.
the point Peter is making is the different investing philosophies, right? Active versus passive, right? Do you just follow the index, or do you actually have your own way of thinking and try to beat the market, right? So both are different, right? With active, you tend to pay more fees. With passive, you tend to pay less fees.
Yes.
With active, there is a chance that the fund manager will outperform and therefore um, justify their fees. But then there's also a chance they will underperform. So at the end of the day, for both, you need to look at long-term performance and make up your own decision.
That's right. So I think some of the viewers are already scolding me. They say, "Hey, you're talking too much. You should ask Ken to talk." So Ken, why not you go into the part of re-optimization? Yeah, because now we've got about 200 people watching already. So I think it's about that number already right now. So yep, let's go.
Cool. Oh, this is a very big show. If you can see my screen, can you let me know?
All right.
You can see my screen?
Yep.
Okay, so I'll start here. So the title slide is basically the fact that we're moving into a different economic environment. So let me break down some of the terms. It's actually not very complex, but finance being finance, the term and the jargon we use sometimes can be, we use very big words that will earn you a lot of points in Scrabble and things like that. But basically here you have two statements. You have the US economy entering inflationary growth. This statement just means that while the US economy is rebounding very nicely, inflation is higher than average, okay? And then non-US economies, which is rest of the world, China included, Latin America, Asia, entering disinflationary growth. Disinflationary growth is a big word for low inflation. So that means, in other words, we are in good times because inflation is low or under control, and also there's positive growth. So when we were speaking about StashAway's systematic way of investing, which is called ERA, it really makes sense to look at this quadrant. So this quadrant is basically a very simple 2x2. On one side, you have growth. On the other side, you have inflation. In different economic zones or regimes, different portfolios do better. Okay, so if we are in a recession, like I said before, you would naturally want more bonds. If you're in good times, you would want more secure assets like energy or even tech or emerging markets and things like that. So right now, based on the statement earlier, the US side is in inflationary growth. Okay, that means inflation is high, but positive growth. Okay, and the rest of the world is in good times because we are also emerging out of the recession, and because the other economies have not printed as much money into their system as much as the US, their inflation is still under control. So when I show you any changes to the portfolio and any reoptimization that happens, is basically a move from one square to another square. Okay, so we move as an economy, things move along these things, and as we move, we will re-optimize, and whenever we optimize, we will let you know. Okay, so let's look at what we were in before and what we are in now, and what are the major allocations or asset allocations that we've made in the previous portfolio and now. Okay, so we were in what is called an all-weather strategy before, because when you remember this quadrant over here, we were in the middle of good times and a recession. So it was not clear based on the economic data that we were strongly in a recession or definitely in good times. So in order to diversify and manage risk, we entered what is called an all-weather strategy, which basically blends the allocation of two economic regimes together. Okay, so we don't want to be overly confident and bet that, okay, we're definitely in good times or definitely in recession, especially since, as you all know, last year, the US government printed a lot of money and that made the financial markets do very well, despite the fact that the US was in a technical recession, 2 quarters of negative growth. So we were in what was called an all-weather strategy, this circle over here. So in that all-weather strategy, the major asset allocations that we exposed our clients to on the equity side was more on the healthcare sector, consumer discretionary, Chinese tech stocks, small caps. And on the protective side of things, where things like bonds and gold, we had international corporate bonds and emerging market bonds. So now that we are in inflationary growth, what do we have to do? Okay, we have to firstly protect against inflation. And how do we do that? We expose your portfolio to things like energy, which, as you know, has done very well. The oil ETF that we have picked for you has gone up 41% this year, and the economies are still reopening, so there's upside to be had there. There's also some exposure to Aussie equities, and if you know anything about Australia, it's a very resource-rich country. It's got the world's largest miners like Rio Tinto and BHP Billiton, and based on that, they have a lot of mining companies there, which tend to do very well in inflationary environment. But we're still in a growth phase as well. Inflation in itself is not bad per se. So, you have other asset allocation, things like staples, which you need in every single environment. Chinese tech sector, which is growing quite nicely. In terms of progress, I'll come back to this later on. Small caps, which do very well in any growth environment, which we haven't changed much. And then when we move over to the protective bonds side, gold, international corporate bonds, and emerging market bonds are the same, but we now have included exposure to US REITs and also inflation-linked government bonds. US REITs are a very unique asset class because they give you a yield, but there's also upside. So if there's any capital gains to the properties and all that, you have some upside. This ETF has gone up 25% this year, and with the yield that is attached to the tenants paying rent, you get a good return from that. And then you have inflation-linked government bonds. Inflation-linked government bonds is very unique because basically it hedges out inflation completely. So if let's say inflation is 3%, then the bond will return 3% in coupon. So this is where we were before, under all weather, and now we are under an inflationary growth environment. Okay, so if I were to move on and summarize this new re-optimization, we need first and foremost broader protection against inflation, which is why we have increased allocation to energy ETF, Aussie equities, emerging market bonds, and REITs. Okay, and then we have maintained our exposure to China tech. Okay, so I want to spend some, just like 30 seconds talking about China, but of course I can talk about it a bit more if you ask. So essentially, I understand that the Chinese government is cracking down on a lot of large mega companies, tech companies in China, like your Didi, Meituan, Tencent, Alibaba, of course. And all of this is making the ETF go down a lot, right? So this ETF in particular has gone down, I think 17-18% year to date. Right? Last year it did very well. It was up 50%, 53%, but this year it's gone down a lot. So it's given back some of those gains, right? But if we just focus on the medium term, it's very hard not to be bullish about China tech, because if you break up these monopolies, for example, there's like people that drive for Didi actually cannot drive for other tech companies, but that's actually not very good practice in the end of the day. And if China cracks down on these things and opens up the tech market a bit better to increase competition, then we think for the long term, other firms will tend to do well. So you don't have just a few small firms that do well, but a few firms that do well. And then also, if you look at the advancement of technology like 5G, driverless cars, China wanting to build its own semiconductor factories and servers, there's a lot to be bullish about in China, right? I think they've even mentioned things like 6G. I don't know what ramifications that has, but if 5G is already uber fast, 6G is going to be ridiculous, right? And it's all coming out of China, right? So it's very hard to be bearish about China, especially in the medium term, which is why the exposure is still maintained there. Okay. When we change it in the portfolio, it looks like this, right? So I have two portfolios. I have the 20% and the 36% one. Then we show the previous weight of the allocation and then the new one. So it's fairly simple. If you see here, previous weight equities used to be 31%. Now it's about the same. Okay, so that doesn't change much, but the underlying ETFs may change. Let's take something that was a real change. Let's say real estate used to be very few change, now a big change. Yeah, so it's very clear what the changes are to you. Okay, this is how some of the portfolios look like now. This is the 6.5% one, is the least risky one. This is the balanced one. We can talk about it more later. So each color is an ETF. So you have like 9 ETFs here. This is the 22% one. This is the 36% portfolio, which is the riskiest one. This one has given us returns of 17% per annum in the past 4 years. So it's done very well. And yeah, you can see it's very heavy on equities here, but also quite well balanced with some bonds in there as well and some REITs. So before I stop sharing screen, just want to share with you our returns over the past 4 years. So if you look at the annualized return, which is very useful in comparing different portfolios, you'll see that high risk, high return, low risk, modest return. So if you're not taking a lot of risk, you can expect a modest return. If you're taking high risk, you will get a higher return, right? So the portfolios do exactly what they should do, right? They are volatile for sure, like the 36% portfolio last year fell 30% at one point, but because it's not more than 36%, we see it as being under the risk budget. But then it promptly recovered very quickly, and it has averaged around 17% every year since launch. So don't think that, okay, I silang, I go into 36%, sure I make money, right? That's not the case, right? You will have some negative returns and all that in the medium term, but we have not finished any calendar year with a down year. And also, we have a relatively long-term track record of 4 years, just shy of 5 years, and every year we've compounded the returns very nicely. So if you had invested in the 36% portfolio since the launch, you would have gotten almost 60%. If you invested in the lowest risk portfolio, you've gotten 12%, but you're not taking a lot of risk either. Yeah. So there's one over here which we introduced in only 2019, which is this 22% one, which is why it's not as high. But if we launched it the same time, it would have been more between 47 to 51. So this is not a what is that? It's not an inconsistency. It's just that we launched this portfolio a bit later. Yeah. So that's it. I wanted to share in a nutshell. Actually, it's not that complex, right? It's basically a change that occurs to your portfolio from time to time. In the time that we've been around, we've only re-optimized the portfolio 4 times. In the Malaysia launch, since Malaysia launch, we've only re-optimized it 3 times. So it's not something that you should expect, like, oh, every month suddenly we change our view like a schizophrenic person. We locate where we are in the economy, and then we pick the portfolio that suits that economic cycle the best, right? That's why in an inflationary environment, you will have things like energy and gold, which do very well. If we enter a recession, then you would expect more bonds. If we go back into good times, then you expect more cyclical kind of growth, broad secular assets. Yeah. So yeah, that's it in a nutshell.
Right. Thank you very much, Ken, for sharing that. So before we open up the floor to people questioning and stuff like that, so let me just ask some questions first, right? Now, firstly, we can see very clearly that while I personally only have the 36% one, being a very high risk person. Yeah.
Okay.
So one thing we can see is this. I think one thing we can immediately see when it comes to the international equity side, we have seen a little bit of a reduce, not very much, right? Just few percent, and same thing with the overall equity sector. There's a slightly drawback, and there's a change from the kind of ETF that we pick to move on more towards consumer staple, which for those of you who actually understand the stock market, consumer staples are usually more defensive kind of stocks, especially when it comes to inflation. So imagine if your Milo increase in price, then these people are going to do well because it's consumer, right? Yeah. Now, one thing is interesting is corporate bonds are adding on to it. So from my portfolio, it will be 0% previous weight to the current weight of 7% to 10%. Now, maybe Ken, you want to explain a little bit why during this period of time they will increase corporate bonds for people?
Yeah. So
for this portfolio, yeah.
Corporate bonds are definitely very interesting because it is investment grade, so it's actually not like very risky. It's double B, triple B onwards, triple A, double A, single A. So all these bonds belong to companies that that have survived the pandemic, right? So they have not gone under, they have not defaulted,
That's right.
and basically they're paying a good dividend, right? A good coupon.
Mm.
So because of
Mm.
that, bonds in any portfolio is acts like a portfolio insurance on the downside. So if, let's say, equity markets take a hit, bonds don't go down as much. So bonds are very useful to blend in to any portfolio, to reduce the risk, right? It's about risk and return. It's not just strictly about return. So why do we pick corporate bonds? Because it's higher returns than normal treasuries and also bonds, government bonds, because US interest rates are very low, 0.20 to 0.25%. So you can't expect a lot of yield out of those bonds. So that's why corporate bonds play that role. They help you with inflation because they give you a coupon, and at the same time limits your downside if anything happens to the equity market. So for example, now with the Delta variant, US markets had a little bit of a hiccup, down 1-2% the other just 3 days ago. Having bonds there would mean that your portfolio won't go down as much, right? And the true secret to kind of like making money in the long term is actually to not go down as much, right? Because if you go down 50%, your portfolio needs to perform 100% to recover. So if you can limit the downside, you will make money in the long term because you're compounding on positive gains. That's why diversification is important. And that's why for those of you who are risk taking, let's say you want to take the 36% portfolio as well, it's about having a good risk return. So let's say this portfolio, which has done 17% per annum, right, as I show you in the table over the last 3-4 years. If you look at the long-term history of the S&P, the return is 16-17% as well. So would you want to take pure equity risk and have the same returns as our riskiest portfolio? Which would you choose? You would ultimately choose our portfolio because it's less risky, right? And it is less risky because it has gold, it has bonds, and it has things like REITs. So if I tell you you can get the same return for less risk, that's what it is, lah. So sometimes people just don't have that perspective because they think, equity markets are good. I'm very risk taking. I want to be hero, and then salang into pure equity or leverage equities or whatever because very brave. That's not so smart, especially if there's a chance that you are an emotional person as well. It's very hard to hold on with like negative 30, negative 40 gains, and negative returns.
Yeah. So actually, for those of you who are watching this right now, and you actually same thing, you hold a 36% portfolio like mine, right? You will start to see that there's an increase in corporate bond, there's an increase in real estate investment trust, and there's a decrease in commodity. So overall, the portfolio that is in the assets, the allocation that are increasing is actually corporate bond and real estate. And the ones that are reducing is actually equity and commodity. And I think this is really very well justified because for those of you who have been tracking the market for quite some time right now, you will realize one thing that equities, standard line, average, there's a lot of upside to it, right? And commodity previously there was a huge upswing, and now it's slowly correcting itself already. Commodity, as we can see as well, and I think it's justified because at the end of the day, there were a lot of speculators in the commodity side, especially when the interest rate were low and stuff like that. So now reducing it from, you can see a significant reduction, especially in the 36%, which is, for me, my commodity side actually has a 16 to 24% of previous weight, which is the amount, right? For those of you who don't understand what's weight, then for commodity right now, it's going to be 4 to 5% only. Means overall, my portfolio is only going to have about 4 to 5% in commodity. And I think that's great. And they're going to move this highest risk, because usually commodity is one of the high risk portfolio asset class that you can actually look at it. Then they're moving this amount towards corporate bond and towards real estate. And why towards corporate bond and real estate? For those of you who are watching, as you can hear, Ken already said, they are preparing for inflationary growth, which means they are preparing for inflation and interest rate will go up, right? That is actually the general idea behind it, and that's why the asset that they pick. Now, Correct me if I'm wrong, lah. Huh?
Yeah.
Based on
So
the analysis, that's
uh,
generally the idea, right?
just to correct you a little bit, so essentially the only commodities we have in your portfolio is gold. So
Mm,
because it's a pure commodity ETF, right? But there is still some other commodity exposure here in the
right.
sense that your energy, we have picked an energy ETF as part of the mix, and also there's
Mm,
Aussie Equities, which has some weightage. It's the second largest weighting in Australia is commodities. The first largest is like FI, so for banks and things like that. But
right.
basically, we are reducing our exposure to gold because there is other inflation protection, right? Like the corporate bonds, like
Mm,
energy, like Australia equities, like
mm,
the REITs. So we don't need that much gold. Okay, so
right.
yeah, the only reason why we classify energy ETF as a equities is because if you pick the energy ETF that follows the price of oil, it has some peculiarities because it's tied to the contracts, the oil contracts. So you will not get as much upside, but when it goes down, it will go down. So when it goes up, there'll be a lag effect because what the oil price ETF is reflecting is not the spot crude, but the futures contracts. And futures contracts only go up when there's new futures contracts being signed. So if people have hedged the lower lower cost, they don't gonna rush into a higher cost contract. So that's why we have chosen a energy equity ETF, which is made out of oil companies. So you give you some exposure to oil, but kind of like indirectly through the oil companies. You know, your BP and Shell and things like that.
All right. Yeah. So that's about it when it comes to like the idea behind it. And for me, because I only have the 36, so I can only base it on that. Now, I promise you guys that I'm going to share with you guys what's my return. And then we're going to go into a lot of questions for Ken because a lot of people really have a lot of questions for you, especially they're going to start asking you stuff like why you don't choose this ETF, that ETF, right? Yeah. So all these hard questions, I'll leave it to you. But generally, this will be my return time weighted 18.92%. Yeah. And money weighted will be 23.89%. Now, maybe before we go into answering question, Ken, do you want to explain to people what's a time weighted and money weighted? What will be the
Yeah, sure.
difference?
So it's if it's all too confusing, you can always use simple return and see how much money you put in and how much money you have made, and you go, okay, I have made, let's say, 20% or whatever. So the difference between time weighted and money weighted is time weighted looks at the first time you invest until now, how much money you have made. So obviously, if you have dollar cost average and put in more money, it will not look at those other inflows that you have made lah. This is so that you can assess our skill as a fund manager. So for example, if let's say I invest in a very risky way, which gives you when you first put your money in the first month it goes up 10%, after that it goes up 20%, and then it goes down 50%, and then after that it is flat, and then after that it go up again. So that cash flow in and out is not really captured. So you purely just want to look at how much money you have made since the time that you invest. So that's the simple way to answer it. The money weighted one means that it weights your contribution and weights it highly towards the big inflows and deposits that you have made. So if let's say first you put 1 ringgit and that 1 ringgit did 100%, so it went up to $2. But then after that you put 100 ringgit, and then this 100 ringgit has only gone up 10%. So the money weighted average will average it out and look at the bigger one, the bigger deposit, and weight it closer to that. So it won't show the 100% which you made on your 1 ringgit. It'll be closer towards the 10% that you've made on your larger deposit. So in a nutshell, that's what it is. It's industry terms that it's used by a lot of fund managers. But if it's too confusing, just say, okay, I used to put I net I put in 1,000, and now it's 1,500. That means I've made 50%. And then if you want
Right.
to make it comparable to other funds, you can take CAGR, CAGR, compound growth rate, and then you say, okay, I've invested over 4 years, right? So 50% are made over 4 years. Then the formula will return you something like maybe 15%, 60% every year. So
Right.
then you're like, okay, roughly that's how I understand it, right? But it is what it is, and yeah, whatever helps you understand returns the best, just use that.
Anyway, there's an article that you can read on their website itself. Let us open up more time for questions right now. So those of you with a question, go ahead and ask. Let me pick up the first difficult question here. So by Kinji, it says that I noticed some investors have a Great Britain pound portfolio. I suppose that's what it means, which is slightly different. How's the GBP return, and how do we access it?
Yeah, the GBP returns are broadly the same, especially if you uh, if you look at the risk return. So they won't be exactly the same, but they will broadly be the same, especially in the long term. In plus minus a few months, they won't be the same. So the GBP returns, the GBP portfolios are a parallel set of portfolios to the US ones because we have capital controls in Malaysia. Capital controls means the Bank Negara restricts the flow of the ringgit, right, in and out of the country. So we have to meet certain criteria. So for certain people who have what Bank Negara deems as domestic ringgit borrowings, which in this case means that maybe you have more than one home loan and one car loan. Let's say you have 2 home loans and 1 car loan, then you are deemed to have domestic ringgit borrowing. You can only invest 50% in Sharia portfolio, up to 100% actually, and then 50% can be conventional, or you can have 50% in local currency ringgit and 50% abroad. So because of this technicality, the route we have chosen is 50% Sharia and 50% conventional, still overseas. And where are there good Sharia ETFs? Not in the US, it's actually in the UK. There's 2 decent Sharia ETFs there. So we use that along with gold, which is Sharia, to form 50% of the portfolio. Then the other 50% we throw in other conventional assets. So we are using that method to comply with the capital controls. It is not better, it is not superior, it's about the same. There's no conspiracy to hide it, whatever. We're just trying to comply. And ultimately, if we didn't have to do it, we would not have done it. It's just, we want to serve all Malaysians. And some big Malaysians, like your uncle or your auntie, be like, hey, I have 3 cars, I have 3 loans, so I did domestic ringgit borrowing. So does that mean I cannot use StashAway, right? Like that's ultimately the if we want to remain in Bank Negara's good books, then that's just what we have to do. So how do you access it? Okay, so you must declare the truth, right? So if you tell us when you onboard that time, how many home loans you have and how many car loans you have, and you have more than, let's say, you have more than 1 home loan, you have 2 home loans, then you will be deemed to have ringgit borrowing. And that's the portfolio we'll offer you in GBP. It's not like I suka like the ETF selection of GBP, and then I say, hey, I have two loans, whatever. Then actually, if you update us that way, we will be obligated to ask you to sell your ETF portfolio, and then fill up the form, and then invest again into the pounds portfolio. So you will incur some cost because 0.1% charge to convert it back to ringgit, and then 0.1% to convert it from ringgit to GBP and send over there. So it's a bit mafan, and it's a bit,
Right.
yeah, it's not not worth the hassle. So just tell us the truth, how much loans you have, because you are declaring your liabilities to us as a financial institution. Then we have to comply with the Bank Negara's foreign exchange administration rules. So because of that, we have these separate portfolios. I find it very funny how keyboard warriors like to find funny things and think that there's more to it. They read into it more than there actually is. And then I saw one Malaysian investor who invested in the GBP portfolio in Malaysia, but then he opened a Singapore account and he invested in the US portfolios there. right? Which we obviously don't offer the GBP ones in Singapore because there's no need for it.
There's no need.
There's no capital controls. Yeah. So then he's like, at one point, the GBP portfolios were doing better. And he said, oh, somehow Malaysia one is better, right? Then it's just like, it's very funny to me lah, because they think that there's something to hide. And it's like, no, we want to comply, and we bend over backwards to follow the rules. So we have a parallel set of portfolios. That's all it is. I see some people sometimes. I have unleashed the code, right? Like the cheat code, triangle, square, circle,
No,
up,
no,
down,
it
up,
makes
down,
more sense.
R2. that doesn't leave unlock new portfolios. Like, no man. There's just rules we have to comply with.
All right. So she actually have one more question, he or she lah, right?
Yes,
Which is when there are some negative returns for some ETF, right?
Yes.
And then since you're removing it and redoing a re-optimization, does it mean that you're selling it at a negative return? That's what the question is about.
Yes. We are realizing the loss, but there's no like tax benefit or anything like that, or tax liability to be had. Ultimately, you must look at the portfolio gain and loss, right? So if you look at if we have, let's say in 1 year we made 10% returns. So for the first half of the year, we choose a certain amount of portfolios and it went down -5%. And then we changed the portfolio and then it went up 20% to give you positive 10% by year end. So you must look at the portfolio total returns, and that's what we measure. So of course, with the rebalancing, there'll be some gains, some losses, and then there'll be a new portfolio. But then we will the way the accounting of the performance works is that we will look at the gains and losses in advance of the portfolio. Yeah, correct.
So for those of you who are actually investing in StashAway, some of you, I know you all like to go into the details and say like, hey, my China is dropping by 35%. Wow, and then you rebalance, that means you cut loss for me. Hey, it doesn't work like that. When you want to invest in a portfolio, it's a portfolio.
And also
as a portfolio.
Yes, and also China is still a large allocation there, so we are maybe trimming a little bit, but we're not adding. So in the past reoptimization, let me just put it this way, people love.
There is a question regarding China here, which I think you will actually also answer it. As you explained. So why not? Let me just put it up for you. Now the first question here is about can you explain more in detail why allocation into China tech ETF could be so large while China is weakening on all fronts due to CCP. Now, the second question also regarding China is why don't StashAway pick China semiconductor ETF since the government is trying to focus to be more independent in this area? So maybe you can lump it up and explain together.
So I think you need to besides the things that I mentioned just now, I think you need to be very selective when you're playing with China. I've had some experience dealing with China investments as well, and the thing about China is that it doesn't. When you invest the time, it's not always what it seems according to the public image of China as a whole. So when in the early 2000s, when China was posting like double-digit returns in terms of GDP every year, it was like, wow, if only I had exposure there in the stock market, it would be amazing because I get to ride this awakening dragon or something like that, right? It's very colorful because there's so much cultural things you can draw from it. I am Chinese, whatever, right? Like, so it's just you need to go straight to the returns. And the thing about China is when you look at its economy, it is also a patchwork of economies because it's centrally planned. It's not like organic, so it's not perfect. There are banks there that do very badly because as a state-run bank, it is meant to take up a lot of the bad loans. And then you have bloated SOEs. They are like GLCs here. Some of them are not efficient. They hire a lot of people. They don't really automate and all that kind of thing. So you really need to pick your spot. So if we look at China Tech, KWEB, we chose it at a time where in COVID, amidst of COVID, when physical supply chains were not up and running yet, and China was not out of the COVID situation. So that is why we preferred software companies over the semiconductor companies and the foundries and things like that. So that kind of answers it. And you need to also choose your Chinese exposure because there are parts of the China economy that you don't necessarily want exposure to. Let's say like maybe real estate, or you don't want those sovereign wealth funds, state-owned enterprises that are like banks and things like that. So that's why we've chosen tech, and that's why we've chosen more software focused. So naturally, when things are being hit, everyone is focused on it, right? So it has not done well in this year, and we think actually a few more big firms will be hit, right? Which is why we are also not very concentrated on just one or two companies, right? We don't see us, oh, Alibaba is like a monopoly there, so we just pick a large allocation to just the top 5 companies. Queb has over 50 software companies. So ultimately, we think that it is bad news. The ETF has gone down a lot, but we think that a lot of it has been priced in. If there's a few more hits to come, sure, just take it, and then ultimately you will recover, because long term, like I said before, there's so much innovation coming out of China. I'll say like Chinese tech companies are more innovative than US companies per se, because if you look at what the actual innovations are, if you see the US ones, they're a lot more kind of like social media, media. The tech is not like physical tech, whereas the Chinese techs are a little bit more on the practical side, like IoT, like 5Gs, or like infrastructure type plays. And then their big guys are all super apps, right? It's not just like WhatsApp. You have like Tencent or that, which does everything, right? They are getting hit because they're monopolies, yes, but also they are diversified firms. Alibaba is not just a financial company, right? It's an everything company. Tencent is an everything company. They own like movie studios as well, right? So it's very diversified. So if they get hit, sure, they get hit, right? But they are because it's diversified, we're not too into certain subsectors, like just semiconductor, for example. It's quite broad. So ultimately, I think that justifies our selection of China internet companies.
Right. Yeah. So maybe it's so that it doesn't get too concentrated on one particular industry and absorb all the risks when it happens, right? Yeah.
Mm-hmm.
Now, there's one question here. I think this just is a yes or no that will do, right? Maybe you wanna.
There's Daniel on this. Okay, so when you see all this tech jargon, right, you must ask yourself, what good does it do to me, right? Like, we don't say that, oh, StashAway uses all this like machine learning and AI and all that, because it doesn't. But also, we want to communicate to you what's the benefit to you as an investor, not like, oh, it's AI, therefore you must use us, right? So AI is autonomous, right? So there's no like, obviously there's oversight and all that kind of thing, but it's like it can learn and it can like do things itself. And so far there's no real application for managing money that we see that is safe. So not to say that we are experts in the AI space as well. So what we have actually is a systematic way of investing. It's a sophisticated kind of like, if this then that function, right? And of course, the main driver of this is economic environment. And then there's an investment committee with people that look at the output of the system and say, okay, we are in an inflationary environment. The system is suggesting that we choose these ETFs. Then these ETFs came from our selection anyway. So we check the weightings. And then when we actually press the button to buy and sell, actually it will take a few weeks, maybe like 3-4 weeks, because we also want to choose the best time to switch over the new assets. So, sometimes the economy and the financial markets may be disjointed, and sometimes we wait a few weeks in order to act. Yeah, so it's not like there's a Jarvis there which like does what it wants. And yeah, so no AI involved. Systematic investing is our method.
Right. So some people are also asking this question, which I think for our Muslim friends out there, many are
Mm-hmm.
actually asking this question: why did StashAway Simple chose to switch to a non-Shara compliant fund? Yeah.
Mm-hmm. Yeah, so it's when we had the old portfolio, it was a money market fund, and we chose the money market fund, and it was incidentally Sharia. We didn't say let's go after the Sharia market. Let's choose the Sharia fund. We chose a fund that was incidentally Sharia, so we did that. And if you ask why are Sharia money market funds giving higher returns than other money market funds, is because Sharia banks give higher interest to attract depositors, right? So that's a very natural thing to expect. And then, so since last year, actually during the time where Guan Yin was the finance minister, he wanted to close an exemption on corporates having tax exemption on money market funds.
Yep.
So we had to change from money market fund into what is now a low risk bond fund, which is 50% FDs and 50% um, short duration bonds, short duration corporate bonds to be exact. So it's good that you ask this question because it's good that you should know what we are invested in. And StashAway Simple is still very low risk, even though it's technically a bond fund, because there's no tax on a bond fund for a corporate like us. So if there was a money market fund, there will be a tax, and they actually kick the can down the road to January next year. But the actual shift was June, or was end of June, early July this year. So they only told us that it will be, told the industry that it will be next year, January, 2 weeks before the end of July, before the end of June, which was when we actually changed the portfolio to this low cost bond fund. And naturally, with bonds, it can't be Sharia anymore because it's not sukuk. So, and you should also understand that, that means now this bond, because it's a bond fund, it means it's high risk. No, it's actually not, because of the way the fund is managed. So 50% is FDs, and then the other 50% is short-term corporate bonds. And these short-term corporate bonds are not traded, meaning when they buy these bonds at par value of 100, they will get a coupon of like 3 to 4%, depending on the rating. And they will hold it until duration, meaning until the end of the bond. So if the bond is 6 months, if the bond is 1 year, they will hold until the end. And then they'll sell it, they will redeem it back for 100, $100. So there's no capital gains and losses on these bonds. These bonds are mainly there to collect coupon. So that's a huge difference to a normal traditional bond fund, which is what you think of, where fund managers are picking and choosing bonds to get a coupon, but also to profit from trading the bonds. So I think it's a technicality, but it's a technicality that assures you that it's a low risk bond fund. And with a low risk bond fund, there's no tax on it. So we get to give you good returns, or good returns at least compared to FD, right? So yeah, I think that's ultimately our position on StashAway Simple.
Right. There's one question here that I think is really a tricky one. So Aq, if I'm reading the name correctly. So she's saying that he or she is saying that since you mentioned about Aussie ETF is chosen because it tracks commodity and mining stock, which is used to hedge against inflation. So why do you want to choose the ETF on Australia equity? Why not just straight away go for a commodity ETF, right? Yeah.
So with commodity ETFs, they tend to be very focused on one or two commodities directly. So like I said before, if you pick too many, then there'll be certain costs associated with it, and there's certain contracts associated with it. So for example, if you pick oil, then the oil ETF will not directly track the price of oil, right? And let's say you pick copper as silver, right? Then there's also certain contracts associated with those. So that is the main reason. Australia has done well in inflationary environments in the past. and that is why we have chosen it. And when we pick these ETFs, we simulate how it did in the past. And these ETFs need to have a long-term track record. Their cost needs to be low. It needs to be very liquid. So there's also a selection criteria when it comes to each and every one of these ETFs. So it's not like we see things that are going up and then we include it in our universe and then pick them when we want, right? So we already have a set of predetermined ETFs because we've done our selection on them. And then when we go into inflationary environment, that's then when we choose these ETFs. And in this case, it's Aussie ETFs.
Okay. Now, let me also highlight some very difficult question. At least Q like to ask you a very difficult question, Yeah. Yeah. So he's asking another one more. Yeah, which is what's your macro view on Asian ex Japan and emerging market, and what's the rationale behind removing AXXJ and SPM? He also mentioned about in the later question there, he also mentioned about one thing, which is since most developed countries are coming out with so many quantity easing, and this money would have trickled down into emerging markets and would lead to more inflation in emerging markets. If you want to answer the question,
yeah, of course. So I think it's a relative thing, right? So because these emerging markets have not printed as much as the US, their currencies won't weaken as badly against the US. So that's why we still think that emerging market bonds, for example, still hold up. With regards to why we took out AXJ, I think AXJ does very well in good times, and because we already have Asia exposure, Asia exposure through China tech, that allocation kind of like didn't really, it was a bit more redundant. So that's why Aussie Equities was a better choice as opposed to AXJ. Right? AXJ does very well in certain situations, which we are now out of already. So ultimately, when we move from one economic regime to another, some ETFs do well and some do not do well. So because from the US side, we are seeing inflation, naturally and also the non-US side is not in an inflationary environment. AXJ is not something we have selected anymore. And also the things that do well in this environment are the ones we have chosen. So it's more of a process, and sometimes it's not very intuitive. It's not like we think this will do well and we have this view, therefore we choose it. It's based on the macro data that we see and where we are in the economy. It's as straightforward as that.
Okay. Before we go into, there are some easier questions which I'll leave it at the later one. Yeah. I'm not sure if you want to. I think that kind of already answers it. Really. I don't have to bring up. So someone also asked about like Katie Wood thinks that the U.S. environment is going to be deflationary instead of inflationary, but I think no, it's more towards individual opinion, right? Because her opinion and Michael Burry is a whole total opposite, right? And conventional, unconventional. But I think we won't go into that because I think it will lead us down to another rabbit hole. Yeah. So let's focus a little bit on some more important questions here. I think firstly is that someone mentioned about this thing, right? About the in Singapore, they StashAway offers an income portfolio. Yeah. But in Malaysia, how come it doesn't?
Yeah. So I think.
Or when is it coming? If it's coming.
Yeah, I think yields are so low, right, in Singapore, and because of that, they want certain yields out of their REITs and their bonds to kind of do better than their FDs lah. So that's the main reason why income fund would do well there. Here, I think it comes down to asset selection, right? Do we want to form a ringgit class yield fund or income fund? Maybe, if you guys tell me that you want something like that, maybe we can look into it. But we think that that there are other products which are more exciting, which we may introduce soon. So we've been working on that as opposed to just a straight up Malaysia income fund. We also look at things in a more global perspective. For example, we are now in 5 countries, and we don't just want to do things for introduce products for local countries like just Malaysia, especially if it doesn't make business sense lah. So whatever products that we want to introduce in the future are kind of like world class, worthy of being world class funds that we introduce to Malaysians, not just
Right.
Singapore have, so we want to do, and it's ringgit class that can only cater to Malaysians, right? Like someone in Hong Kong
Right.
will not care about Malaysia income now, right?
That's right.
So I think it's a bit of business sense, but also it's a little bit of prioritizing certain things that we want to launch. So that is not something we have chosen. Everyone will want something, right? Our Muslim friends may want Sharia, which is also something like we want to do, but we cannot prioritize. Income fund, if we have, it has to be of quality, like it has to give us a good 5 to 6% recurring yield, which is not easy in this 1.75% environment, right? So especially since you have to make it like not very risky, because people who use income funds, tend to be like closer to retirement or already retired. So the capital appreciation on that cannot be so volatile, right? So you cannot
That's right.
just simply do, right? And when you look at how you would build an income fund for Malaysia, there's only so many ETFs here that lend themselves to that. We don't have a REITs ETF, for example. We can create one, but that takes time. There's a bond one, but the returns are like there are more government bonds in there. Dividend ETFs also, I don't think there's some high quality ones. So in short, susah sikit lah. Susah.
Yeah. One more question here is that Brian actually mentioned that StashAway actually removed the auto re-optimization. Yeah,
Yeah,
and this
we did.
change is not favorable. Yeah, so you want to share with us a little bit about the reason behind this move and what's the implication?
Yeah, we thought very long and hard about it, but when we really look at why people used it and how we were able to service the people that did use this function, we ultimately made a choice to kind of like streamline and make everyone kind of follow our optimization lah, right? When it comes down to things, you have to decide for yourself whether you want to tinker and customize to yourself, or you allow us to personalize for you. Personalize means that we come up with a curated set of ETFs. There's a risk portfolio you can choose. You can also have multiple set of portfolios. So that combination is kind of like uniquely yours lah. But if you say, oh, I want, instead of KWEB, I want this other one, and then I want this ARC fund as well, and then I want copper instead of Australia, then yeah, you can go ahead and start your own portfolio, right? You can do that, because if we allow that tinkering to happen, then we cannot scale and grow as fast, right? So the reason why we took it off is because less than 10% of people were actually using it, and when we asked them, why are you using it, they cannot articulate why. A lot of them don't really know why. The ones that really know why they're using it, usually it's because they like the selection of ETFs when they entered StashAway in the first place, and they wanted to keep those ETFs, right? So, okay, that's fair enough. And then the thing is, once we, so we have 12 portfolios, right? And then if we allow you to keep your old portfolio when we re-optimize, essentially we have to maintain 24, right? And then we go do it again, then you have 36, then 48, right? So because of that, the old portfolios, which was like 1 or 2 years ago, only a few people are contributing to those. Only a few people are withdrawing from those. And because the orders are not so big, sometimes they need to wait a few days for us to operationalize the buying and selling, because there's some minimum order size and things like that. So ultimately, we don't think that we were serving those people that kept the old portfolios particularly well, not giving them best pricing. And if we replace some of the ETFs, because they are objectively better ETFs already, let's say the S&P 500 one. When we started, it was this one called SPY, and then we moved on to IVV, and IVV was clearly better. It was lower expense ratio and had probably a better tracking error as well, right? It was smaller tracking error. So if we already find something better, I think we have earned the position now where I can say this. If I was in my first year, I wouldn't say this, but I think you should trust us with managing your money, right? If you really don't trust us, I don't think you should be with us. Then you should open a trading account and choose your own portfolios. By all means, you can follow our portfolio, right? Nothing is stopping you from seeing what is in our portfolio down to the weightage and then having your account elsewhere and you do all the paperwork with that. It's fine. But I think you really have to look at it from the big picture, right? And the big picture is we want to serve a lot of people in a very efficient way. We don't make a lot of money. We only have 0.8%. So there's only so much we can do. And when there's complications from old portfolios being kept around, the administration of it is less high quality than we would like. Ultimately, we make the choice to take it away, right? And and if you imagine, the word re-optimizing is something that we came up with, right? And the feature of using it or not is something that we came up with. So ultimately, I think, it's something that was experimental at the time, and ultimately not a lot of people chose to use it. And because after 4 years, we thought that we were already doing right by the people who have trusted us who have opted in, we made a decision to take it away, right? And I'd say that the number of people who were truly upset for the right reasons are very few. I haven't gotten like a real complaint, right? There are complaints
Right.
yeah, why like that kind of complaints are, but not like really strongly justified. Like one person did tell me like, oh, it's not transparent. But then after I explained to him why we change and we reveal the ETFs to you, actually it's like, oh, I didn't know you can see the ETFs. It's like, yeah, with one more click, you can actually see the ETFs already.
Right.
So I guess it's up to you, right? You really have to make a decision on whether you agree with our way of managing money, you are impressed or not by our returns, and happy with our service. And yeah, that's the stance that we've taken now.
All right. Let me just throw you a hard question here that someone is asking here, but I'll not pull up because you break it into multiple comments, right? Yeah, I'm
Okay.
not sure if you've seen it. Yeah, so the person is saying that he is someone who is all in for passive investing, but he feels that StashAway has being an active ETF picking, it is not too different from actively picking individual stock, right? So although the person is still a supporter of StashAway, he still thinks that it's a good one and he will recommend it. But he mentioned one thing, he thinks that StashAway may not be passive enough because he mentioned that, yeah, he thinks that at the end of the day, it is not too far different from picking individual stock. And number two, this is the part that maybe I'll just read exactly what he said. Majority of stock picker will not outperform the market, and I believe it's the same with ETF picking. I'm all in for their auto rebalancing, just not their auto reoptimization. StashAway is great, but it's just not passive enough for me. Yeah, so I kind of don't really get the question as well because
No, I understand.
yeah,
So
but I kind of get it. Yeah, so yeah.
yeah. I think so. Are we 100% passive? No, right? Because we do change these ETFs, right? And the reason for that is because there's a style of management, which I would say is like semi-active or semi-passive, whichever you want to see. Glass half full, glass half empty. It's really up to you. I would say it's not the same as active stock picking because, firstly, active stock picking, there's a lot more churn, right? So there's a lot more buy and sell shares and all that. And for us, we've only made changes 4 times in the last 4 years. So we only make moves if the estimated return is truly justified, right? So let's say we have entered into an inflationary environment, and then this set of ETFs are really expected to give you a plus 1% or more expected return, and it's truly justified. Then only we'll do it. We don't do it because, oh, we have changed economic regime, then we automatically do it. That's not the case. It has to be justified. And in terms of benchmark, we actually do use a benchmark, and we do beat our benchmark as well. So I would say that we are not the same as active lah, but we are better than passive as well because we have benchmarks and you can see them on our website. So what we do is because we use a multi-asset portfolio, we use combinations of an equity index and a bond index. So let's say for the 60-40 portfolio, you might look a certain way, but it's equivalent in risk in the let's say we say 22% risk, right? So we can also apply this to the combination of the benchmark to be also 22% risk of this benchmark. So because we've created this benchmark which is risk based, then and we beat it, we think we are doing better than a purely passive kind of benchmark as well, because the purely passive benchmark is okay. If I invest in S&P, forget about benchmark because everything is just the S&P. If I invest in world government bonds, that return is what I get because it's purely passive. And we've combined these two together, these two benchmarks to create our own, which is risk based, and we do beat it. So I would say that we do better. I would like to think that it is best of both worlds. It's not purely passive because you shouldn't be married to your ETFs. You can change your ETFs. Not to say you change every day, but we change it based on a certain logic, which I've explained. So if you hold S&P 500, no doubt you would have done very well over the last 10 years, right? You have done 10 to 11% over the last 10 years per annum, right? But with our more aggressive portfolios, even though it's less risky than the S&P, we still perform the same or if not better. So risk return, we think we're better than purely passive. And because we don't churn the portfolios, we don't pick stocks, we are definitely better than active. And we don't charge as much as active. Active is 5 plus 2, 5% sales charge, 2% management fee. You forget your Bridgewater or whatever. You cannot even, if you today you want to go and buy Ray Dalio's fund, you can't, right? Unless you have a lot of money lying around. And that one also you need to pay through the nose. That one, the fees is 2 and 20, right? That's forgetting the distribution fee, right? So let's say the distribution fee is like, I don't know, let's say 3% or whatever. 2 and 20 is 2% and then 20% of your gains. So, I think all in all, we have a service, and it's a service that is truly differentiated because we have an investment philosophy. If you agree with it or you want to experiment with it, I'm sure you have, then great. But yeah, is it truly passive? No. Is it actually active? Also no. But is it better than either one of them? I think there's a case to be made that is better than all of them, than both of them, right? So yeah, that's my stance anyway. But then again, I work for StashAway, so you have to apply some Salt Bay and make up your own mind.
Yeah. I'm just thinking to myself that I think we often have this idea that when it comes to passive investing, it really means that you marry a stock. I think one of the things that we need to consider also, this famous quote comes, a lot of people will quote Warren Buffett, right? They'll say that hey, Warren Buffett's favorite time is marry the stock. But maybe if you were to check his portfolio, does he sell anything? I'm pretty sure that you'll see that he sells things. And yeah, it has made headlines so many times that he sells things. So I would say that the difference between active and passive, when you talk about passive, it's not entirely passive. It means that you're alert with news, you're alert with what's happening, you still keep updated with the company, you still know that the company is doing well, you still know that things are doing fine, and that's why it gives you a confidence to stay on, right? It is not, I made the decision 10 years ago and then I don't look at it, and then, 30 years later, I wake up, oh, the company already bankrupt already. It doesn't work like that. So I think we need to have a slight idea of it. But at the end of the day, everyone have their own investment philosophy, right? So whichever that fits to your portfolio, that's the thing that you want to go towards. Now, at the end of the day, I think you also have to understand one thing about StashAway is that they are a business. So the thing is to provide is to provide the thing that generally the majority will align with, right? It's going to be difficult. Let's say StashAway is going to fulfill every single one's need. Yeah, then it's impossible. Even for us on Mr. Money TV, we have a lot of requests, right? Sometimes there are some minor requests, and if I'm going to make a video on every single request, I think I'm going to go bankrupt very, very soon. Yeah. Yeah, because I won't be able to grow the channel, you know. So that's just certain times you just have to make some business decisions. Yeah,
Can
and
I
certainly,
just
yeah.
ask some of your viewers, if you have very strong views about all of these things, like re-optimizing or
Mm,
ETF selection, I think you understand that I I'm a supporter of a healthy debate, right? We are both friends, and we are doing this YouTube thing now, and I don't need to do this. It's like I like to do it, and I think it's good to communicate. But do I have to do it? I can just be a black box and you never see me, lah, right? And then you say you read the you read the CIO newsletter, and you read the stuff on our website, and that's it, right? So my message is, do add me on LinkedIn. You can find me there, Wai Ken. And if you drop me a line and you really want to speak to me about some of the views that you have formed about our products, our service, I'm happy to chat, actually. So don't just say I want to sell you marketing and all that stuff, like digital marketing and things like that. Don't try and sell me some stuff, lah. Just, if you really have some feedback, and some of you are clearly very educated about this and are proponents of StashAway, if it comes from a position of like, if it comes from a good place, I'm happy to have a conversation, a constructive one, right? So add me on LinkedIn, can have a chat, because I'm sure we'll learn something. And we've had situations before where actually we have done things because of people's suggestions. Not everything, of course, but like where it makes sense. We have a very long backlog, and we can add it to that. And then if it's possible, we have resource to do it, and we will do it if it makes sense. So yeah, for those of you who asked those great questions just now, like the guy who just asked us about this active and passive, and then there's a gentleman who also asked about your view of Asia,
yeah,
AXJ, and also emerging markets, and these are great views, right? So just add me on LinkedIn, and then we can have
yeah,
a chat
yeah.
about this as well. Yeah.
That's right. Yeah. So anyway, there's plenty of questions there that we think we can't finish answering. But I think one of the things that is dying in some people's mind is that, will crypto ever go inside?
Okay.
Will
So
crypto ever go inside and part of it? Yeah.
interesting. I think um I myself also, I like crypto. Um, I'm not like these traditional finance guys that like die want to just do that, right? I acknowledge that there's a lot of innovation happening. Um, and I also from time to time can be quite laser eye lah, but like since the volatility in May, the laser eye malap sikit lah. So when it's going up, that's when the laser eyes are truly on lah. So I find crypto to be a great hobby because there's so much to learn, right? Like when there's a new asset class emerging before our very eyes, it's very exciting. I also like DeFi. I also have my bags of certain coins that I like the projects. But will it be part of StashAway, right? So this is the question. And I think that, again, it comes back to, will we really truly add value to including crypto or not, right? So I think that if you want to go buy crypto in Malaysia, and also trust me, people who want to buy crypto, they don't need Malaysia regulation or not. They will just go and get it some way, somehow, right? Just open a Binance account, whatever, Huobi, KuCoin, whatever. They can open because these people are very, very adventurous. They don't mind. They want to take the risk. All power to them. It's fine. But I think if you really want to play safe, you open up Luno account, you can get access to a few Bitcoins there. And those coins are so correlated. Ether and Bitcoin and the rest are correlated at least high 80s%. So actually, if you just want a minimal percentage of Bitcoin or Ether, you can always get it from Luno, which is regulated. And if let's say we had portfolios that had, well, let's say 1 to 5% in crypto, will that truly be adding value to you as a customer? I think I think some people will say yes, some people will say no, because the hardcore crypto guys will not want it because they want 50% crypto, not 5%. The people who don't know anything about crypto will be like, yeah, crypto, what's this? And then there's the people in the middle, right? So I also ask myself these questions, right? Like, do we really add value if we include crypto or not? Not just by the returns, right? So I think risk-adjusted returns is something that it shows if you include it in a 60-40 portfolio over the last whatever the Goldman Sachs report. Okay, you can kind of say like the higher returns in self just justify. But like, what's the difference between you having your own portfolio and then on the side have your own crypto thing, right? So it's not that hard, and also I think we don't add too much value if we do it. But mainly, there's asset selection as well, right? If we do choose crypto, okay, fine, we just go with Bitcoin. So far, nothing has listed yet. I know there's some in the in Canada as well, but honestly, I think it's not in the US yet. It's not in the UK yet in terms of ETFs. And then we need to see these ETFs really track the price of Bitcoin for us to really choose it. So maybe when grayscale lists and then we have a part of it, that'll be fun, that'll be cool. But we also have to see whether it fits into era as well. And Bitcoin and crypto hasn't been around to say like, does it do well in a recession? We don't know. Is it uncorrelated with other asset classes? Sometimes yes, sometimes no. So like, we have to understand it better and we have to be masters of investing it. And so far we're not there yet because our strength is in multi-asset global portfolios that we know very well and we love. So to just go out on a limb and say, let's do it, right? And there are some firms that have, I think it's a bit it's not our stance, right? So that's my long-winded answer towards probably not. But you can see that we and we are thinking about these things, and there's a good reason why we are saying probably not. It's not because we are like not innovative. It's no, but
Nah, I think I think it's a good decision to not include it anywhere in the near future still. Yeah, because I mean generally I also would agree the decision lah. It's not the best decision to include this at this point. Yeah, I don't see that lah.
If let's say the one day, Peter, you have a Mamat session, meet up, right? And then you have some of your and
yeah.
I don't mind like sharing my views about crypto, but because this is a StashAway thing, I have,
that's right.
I have to. The company wants to do certain things, and you have to just come to a group consensus, a group view.
That's right. All right, everyone. So that's all about it for tonight. For those of you who are wondering, how do I myself invest in StashAway, right? I will be making a video on this soon, and I'm going to be updating you guys on my portfolio, what's been happening. And I think it's good to actually do a deep dive into the whole robo-advisory thing. I think there are some of the people who are also asking like, hey, how you're performing compared to the rest of other people, what is it like? Because everyone markets their robo-advisor in a different way, right? Yeah, and like kind of like a different framework and so on. So probably we'll do a video on that to really, really address this. But nonetheless, for those of you who are watching this, I just want to share with you very quickly. For myself, I take a very passive approach. What do I mean by that is I just do a regular dollar cost averaging. I arrange an auto transfer every month. It just invests a few hundred ringgit into my StashAway account, and it just slowly accumulates. And to be very honest with you, I barely even go and look at it. I only look at it like probably one quarter once. Yeah, because at the end of the day, I think it's a passive investing, then treat it passively lah. I mean, you already say that it's a passive investing, right? Then what's the point of you going and check it every day just to see how you're going to make that 2% gain? I mean, like 0.1% gain, I for me, that's my stance when it comes to passive investing. It really means passive. Yeah. So that's my stance. And so far, aligned with my expectation, it brings me the kind of result that I expect as well. So I'm pretty much satisfied in that sense. Now, that's all about it for tonight. Thank you very much, everyone, for participating, And once again, thanks, Ken, for joining us, and being a good sport, answering all the difficult questions and stuff like that. Some people are actually even asking, are you going IPO? But I decided not to bring up all these kind of questions.
Not anytime soon. It's okay. We're still building the business. Very early days. Right. We're only 4 years old.
Right.
And you don't want to go IPO for the sake of going IPO. You need to like, we need the money and we want to exit. It's a long way to go.
That's right. Yeah. That's right. All right. So that's all about it for everyone. Have a good night. Thank you very much, Ken, once again. And if you guys have any question for Ken, do go and add him on LinkedIn. That'll be Wong Wai Ken. All right. And once you add him on LinkedIn, you can actually just talk to him. Just don't be rude, talk to him nicely. If you have any complaints or anything that you're really so dissatisfied about, or I would say that if you really think that StashAway is a good thing, just send him a word of encouragement, telling him that, hey, you guys did a good job, right? I think sometimes you don't just need to contact someone when you have a complaint, but tell someone when you think that the person do a good job. That would give the person extra fuel to go on the next mile, right? So that's all about it, everyone. Have a good night. See you guys. Thanks again.